Is Invesco Nasdaq 100 Income Advantage ETF the ultimate Nasdaq income ETF with its double-digit yield and high upside capture? That's what we're going to find out today. Welcome back everyone. I'm the Swedish dividend investor. So, I made a video about Invesco Nasdaq 100 Income Advantage ETF, ticker QQIA, at the end of March this year. The fund was pretty new and had just announced their first distribution. I was very impressed when I looked at the American version, which was launched in July of 2024. Back then, QQA, the American version, even outperformed the Nasdaq 100 index. With the rebound in April, Nasdaq 100 took the lead again. Alright, so now the fund has been out for roughly 6 months. So I thought I would go over some stats. The option strategy, distributions, performance, warning signs, and my experience owning this ETF. As always, this is not financial advice. I'm just sharing my investment journey, my experiences, and my own analysis. And the info in this video is my interpretation. Make sure to read the full disclaimer in the description. I won't do a deep dive into this ETF, but I have a link in the description to my original deep dive video I made earlier this year. So, if you want a more detailed overview of the ETF, make sure to check it out. So, let's do a quick overview of the ETF with data from justetf.com. The Invesco Nasdaq 100 Income Advantage UCITS ETF is an actively managed ETF. The ETF invests in US companies from the Nasdaq 100 index. It aims to generate additional ongoing income by using covered call and cash secured put strategies. More on that in a bit. The ETF seeks to achieve attractive returns through a combination of the index capital growth and the option premiums generated. It's a small fund of 6 million euros. The total expense ratio is 0.29%, very low for an actively managed ETF, and the fund is domiciled in Ireland. So let's look at QQIA's option strategy. Official fund data shows they physically hold 70 to 85% in Nasdaq 100 stocks, while keeping the remaining 15 to 30% in cash to execute a hybrid option overlay. Now, I have linked a deeper dive into covered call options in the video description, so make sure to check that out after this video. To understand why this strategy is so effective, let's break down how the two options work. Covered calls. You collect cash, a premium, up front. In exchange, you agree to sell your stock if it gets above a set target price, called the strike price. You get guaranteed income today, but you cap your upside if the stock surges way past that target. Cash secured puts. This works in reverse. You set aside cash as collateral and collect a premium up front. In exchange, you agree to buy the stock if it dips below your target strike price. You earn yield on idle reserves while waiting for a dip, but take on the obligation to buy the shares even if the market crashes past your target. Traditional covered call ETFs make a huge mistake. They sell covered calls on 100% of their portfolio, completely capping your upside when the underlying surge. Other funds like KNG stay 100% invested in stock and only sell calls on 15 to 30% of their shares. That gives you upside, but leaves you 100% exposed during a market crash, with zero dry powder to buy lower. QQIA solves this with a hybrid model. Uncapped growth. About 75% of the portfolio sits directly in Nasdaq 100 stocks with no options attached, capturing the bulk of tech rallies. Double income. By writing both calls and puts, QQIA opens up two separate income streams, harvesting premiums when stock rise and when they swing downward. Option laddering. Now, this is something I would like to highlight. Instead of selling all option contracts on a single day, the fund stagger writes options throughout the month. This avoids bad market timing, capture volatility spikes, and keeps yield consistent, unlike traditional covered call ETFs. The cash shield. That 15 to 30% cash cushion drops by 0 during a crash, softening the impact of a market drop on the overall ETF. Only 70 to 85% of the portfolio drops with the market. Automated dip buying. As tech pulls back, those put options get triggered, forcing QQIA to deploy that cash yield and automatically buy top tech stocks at steep discounts. So, what's the takeaway? While partial call funds leave you exposed in a downturn, QQIA gives you tech growth, double option yield, option laddering, built-in cash ready to buy every dip, and less downside during a crash, since only 70 to 85% of the portfolio is exposed to the Nasdaq 100. If you enjoy my work, giving a like, comment and subscribing is an easy and free way to support the channel. Thanks! So going over the distributions. So far, as on the 12th of August 2026, the fund has had 5 distributions and they have announced their 6th. Now, from what I get, a lot of brokers and even Invesco had some problems showing their April distribution. I did get it and it was $0.1655. Summing up the dividend so far, we get a total of $1.0625. Since the share price is in euros, let's convert it. That's about 0.92 euros. Now, since there has been 6 payments, let's annualize it by multiplying it with 2, giving us an annual distribution of 1.84 euros with a share price of around 18.4. That gives us a yield of 10%. Option premium income goes up and down with volatility and the NAV price, but it gives us a nice estimate to work with. When I made the video about QQIA, it also had a 9 to 10% estimated yield based on the first distribution. Sweet. So let's check their performance over at justetf.com. Since they launched at the end of January, the data is limited and we have to go for the max time frame, 14.71%. That is not including the upcoming dividend. So that's pretty decent performance for 6 months and from a covered call ETF. Let's compare it to its competition. JEQP, JP Morgan Nasdaq Equity Premium Income ETF, and QYLE, Global X Nasdaq 100 Covered Call ETF. Now, this is pretty amazing. It has outperformed its competition with roughly 4%. Ever since the Nasdaq started to recover, QQIA has taken the lead over JEQP and QYLE. They launched just before the US-Iran war, and since we don't have more data, we have to see their max drawdown since inception, 7.5%. If we look at JEQP and QYLE, we have to look at the 1-year max drawdown, 7.6% for JEQP and 5.82% for QYLE. So even though QQIA took a beating similar to JEQP, they still managed to outperform. But it's not all sunshine and unicorn farts. There are warning signs. If you're a regular viewer, you might have caught on to the fact that I don't really like the American tech sector. Sure, the technology is life-changing and impactful, but I do think the valuations are very stretched. I have a limited exposure towards US tech. I own both QQIA and JEQP, which is about 7% of my invested capital. But I also own XY7D, Global X S&P 500 Covered Call ETF. The top 9 companies are tech and represents about 36 to 37% of the index. I also hold WINC, and in the top 10, about 19% weight is high-flying tech. Both XY7D and WINC aren't big positions, but let's say about 1.5% from those holdings are in tech. So my total exposure is 8.5%, give or take. Be very careful with this. The Nasdaq has no base dividend to speak of, and if the price of any Nasdaq covered call ETF falls by 50%, you could count on about a 50% cut in the distributions. So that's the first warning sign. The other one is kind of a warning flag. That is the size of the fund. currently sitting at around 6 million euros. Now, why is this a problem? Well, the expense ratio is 0.29%. Very nice for us invested in QQIA, but that's about 17,400 euros for the management. If they don't make any money, the fund runs the risk of being closed down. I don't know this for certain, but my conclusion is that Invesco uses the existing team running their US and Canadian version to run the UCITS one, meaning the overhead cost is very low since they already have the infrastructure down. They do have some costs associated with listing, legal and regulatory fees that are ongoing. However, usually fund companies gives their product at least 1 to 3 years to assess if their product will reach profitability, and usually they will get liquidated in 3 to 5 years, with the average being 4 if they aren't. Another fact is that only half of ETFs in Europe are profitable, according to research by ETF Stream. Looking at extraetf.com, I've used Google Translate here, so things might look a bit weird. Their share count since launch is flat. Looking at other funds, the AUM and the share count goes up at the same time, like JEQP and QYLE. I would consider this a yellow flag. The static share count shows that the fund is currently relying entirely on its initial capital and lacks buying pressure. For a 6-month-old UCITS ETF, this is a known holding pattern, while it builds a track record. However, if the share count doesn't start moving during year 2, we shift from a yellow flag to a genuine risk of closure. I do think Invesco, a fund giant, is in it for the long run, and are most probably paying out of their own pocket to keep the fund running. That being said, I do think it is something we need to keep an eye on. If the fund is still at around 6 million euros a year after launch and not growing in asset under management, we should consider if it's worth holding the fund. When a fund gets liquidated, you will get paid whatever the fund is trading at on the closing day. Let's just hope the Nasdaq hasn't crashed by that time. So what are my experiences with the ETF? I really like it. The performance is stellar and the distributions are very high. I like the call and put strategy. They have shown they can recover quickly along with the Nasdaq, something very important and something people bring up all the time with covered call ETFs. Will you beat the Nasdaq 100 over time? Probably not. But as long as the Nasdaq chugs along, this ETF will perform very well. I decided to split my capital for tech evenly between JEQP and QQIA. I like them both, but I do like the total return from QQIA. I will continue to hold this one, and I will closely monitor the AUM. QQIA represents about 4.4% of my investment income. So even if the Nasdaq would crash with 50%, it wouldn't affect my total distributions that much. Let me know what you think about QQIA. Are you worried about the AUM or the overvalued tech sector? Make sure to let me know in the comments down below. Guys, that's it for today. Thanks for watching, and I will see you in the next one. Until then, stay smart, stay patient, and keep stacking those dividends. Ha det gött!